Hi, welcome back to the channel. So in today's video, I'll be covering ROIC as well as your high quality compounding machines that meet this metric. So for reference, this is my portfolio. So I own a lot of different companies here with extremely high ROIC. So we'll be covering what exactly it means and how to identify companies with high ROIC. So this is what Warren Buffett previously said about the ideal business. So he said that the ideal business is one that earns very high returns on capital, basically high ROIC, and that keeps using lots of capital at those high returns. That becomes a compounding machine. So Warren Buffett over here acknowledges that a company with high ROIC as well as high reinvestment rate is a compounding machine. And besides that, you have Joe Greenblatt as well. So if you don't know who this investor is, his name is Joe Greenblatt. He previously came out with this book over here, which is the little book that beats the market. You can go and read it out if you're interested in it. What he highlighted in the book is this metric, which is your ROIC. So he does some sort of mathematical equation involving ROC, return on capital, as well as P/E ratio. So what he wants with all his different stocks that he owns is high ROC or high ROIC as well as low PE, so low valuation. And the combination of both of these things will make a perfect investment for him. And that is how he was able to beat the market for a sustained period of time just using this mathematical equation. So your ROIC is basically your NOPAT, which is your net operating profits after taxes, divided by your invested capital. So let's talk about your NOPAT portion first. NOPAT is the net operating profit after taxes. It excludes your non-operating profits like your interest income and your minority interest. When a company owns some sort of a stake in another company, it measures the organic profits of the company, the operating profits of this company, and your NOPAT is slightly different from your net income because your net income will include all these different other non-operating income like investment income, interest income, as well as minority interest income. Whereas for your NOPAT, it is organic to the business. It is measuring the core organic portions of the entire business itself. So next one that I'll be covering is your invested capital. So your invested capital measures the capital that is being used to run the operations in the company. So invested capital is basically your assets minus your cash. Because your cash is not operating yet, it can still be deployed in. That's why it is not included in your invested capital. So this portion is your invested capital. So when you're measuring your ROIC, you must compare your ROIC with something called your weighted average cost of capital, which is your WACC. So your weighted average cost of capital is how much it will cost if you borrowed money from elsewhere. So if a company has a weighted average cost of capital of around 4%, and if the ROIC is above their weighted average cost of capital, what this means is that the company is able to borrow money at this rate and achieve returns that is higher than this rate, meaning to say the company is creating value for its shareholders. Conversely, if a company has ROIC that is lower than your weighted average cost of capital, then it is destroying value for shareholders and it shouldn't be reinvesting into its business. So for example, a company like Ford has extremely low ROIC. So Ford's ROIC is actually negative 0.04%, meaning to say if the company reinvested its earnings into the business, it will lose money. So for companies with low ROIC or with ROIC that is below your weighted average cost of capital, the best use of the capital that is being earned from all the different profits is to just give it out as dividends to shareholders. And if a company has low ROIC and is trying to reinvest into the company, that is actually bad capital allocation by its management. And that's why Ford stock hasn't performed well over the past 10 years, and I expect it to continue this way as well in the future. So your ROIC breakdown has two portions. Your ROIC is made up of this first column, which is your NOPAT divided by your sales, and the other portion, which is your sales divided by your invested capital. So I'll be talking about your NOPAT divided by your sales first. NOPAT divided by sales measures the margins of the company. So when a company is able to maintain high margins, what happens is the net income as a percentage of the sales will be a lot higher, which is good for the company overall. The next portion is your sales divided by your invested capital. So when your sales divided by your invested capital is higher, what this means is that the company is less capital intensive. So when a company is less capital intensive, it will also help to drive up your ROIC. So for ROIC, you have high margins, of course. So this is how your ROIC shows that a company has a moat and why you should monitor it when it comes to deciding whether or not a company is able to maintain its competitive advantage. So in terms of your ROIC, you have two portions like we said earlier, your margins as well as your capital intensity. So if a company is able to maintain high margins, what this means is that the company doesn't have to reduce its cost, reduce the cost of its products to gain more market share. And this also means that the company is able to defend its competitors away from the core business, and it's able to defend its market share. And the other portion is your capital intensity. So low capital intensity means that the company doesn't have to continually reinvest into the company, which also means that the company doesn't have to reinvest to stay ahead of its competitors, which is overall healthy as well. It shows that the company has a very strong competitive edge against all its competitors, and it's able to maintain its market share in the entire space. So for ROIC, it is important that you're tracking it. If your ROIC is declining, it could be a sign of weakness in the core business of the entire company. So in the next portion, I'll be talking about companies with incredibly high ROIC. So the first company that I'll be talking about today is MSCI. MSCI is down around 6% this year. It is currently trading at a 36 times earnings. So for MSCI, it is an indexing as well as a software business with high margins and low capital intensity. So if you have to look at the ROIC over the past 10 years, ROIC of MSCI has just grown massively. It went up from around 10% to currently at around 36%. And for your average S&P 500 company, the ROIC is at around 9%. So even if you divide MSCI's ROIC by 3 times, it will still be a lot higher as compared to your normal S&P 500 company. And that's why MSCI is one of the higher quality businesses that you should own in the S&P 500 today. So as for your risk to MSCI's ROIC, there is almost no risk to ROIC. The company will be able to maintain its high margins while ensuring a low capital intensity like it has always been. It's a software business and it is an index business. So as long as the brand name still holds, the company will continue on with its index business. And of course, the high margins will maintain this way as well. The only risk that I see with MSCI is the lowering of the percentage-based asset-linked fees. The next stock that I'll be covering is Google. So Google year to date is down around 0.36%. It is currently trading at a 20 times earnings. So for Google's ROIC, it is quite incredible as well. So Google is currently having an ROIC of around 25%, which is a lot higher as compared to all your different S&P 500 companies. And despite the high reinvestments into the company, despite the increase in your invested capital, Google is still able to maintain such high levels of ROIC. This signals that the company is growing healthily, the moat is still strong, but of course there are risks to Google's ROIC. So Google's ROIC has grown massively because of the growth in Notepad, and due to high margins of the search business, capital intensity has been increasing, which will harm the ROIC in the future if the Notepad doesn't grow at the same rate or at a faster rate. So for Google, the search empire is strong for now, but AI could cannibalize Google's search margin, and ROIC for Google will decline over time. So as we said earlier as well, for your ROIC, there are 2 portions. You have the margin segment, which is very good for Google. They have extremely high margins. And you have the other segment as well, which is your capital intensity. So for Google, they're increasing their capital intensity, which will hurt their ROIC in the future. And if the margin portions start to drop over time, especially when AI comes in, it could lead to a decline in ROIC for Google. And that could be a telltale sign of the company's weakening moat. But a counter-argument to this would be that there is rapid margin expansion in your Google Cloud, and Google Cloud is becoming a bigger chunk of Google's entire revenue stream. So if Google Cloud is able to compensate for the decline in terms of margins in your Google search empire, then this could be a net neutral for Google. But of course, investors must acknowledge the risk that your Google search margins could decrease over time, and that Google's capital intensity is picking up as well. The next stock that I'll be covering is Nvidia. So Nvidia year to date is up around 20% or so. The company is trading at a 55 times earnings right now. So for Nvidia, the ROIC has exploded to the upside. So it is currently now having an ROIC of upwards of 70%. In fact, it is now around 79%, which is quite remarkable for an S&P 500 company. So for Nvidia, the ROIC has grown massively because of the growth in your Notepad with AI search. But there are a few things to consider with Nvidia. The first one is that can Nvidia maintain such high margins? And the second question will be to ask yourself whether or not Nvidia will become more capital intensive over the next few years. So for Nvidia in this capital intensity portion, it is still okay. Capital intensity has in fact dropped as a percentage of the entire revenue stream. But of course, the margins could suffer in the future, which could be a problem for Nvidia in the future. So when you have TPUs coming up, when you have AI commoditization as well, this could hurt Nvidia's margins, and their margins are already sky high. And normally for hardware businesses, it is hard for you to maintain such high margins. So AI could be commoditized in the future, and when AI is commoditized, you will see Nvidia's chips becoming a lot cheaper than it is today. So this was in January when we had a DeepSeek event, when Nvidia dropped around 20% in the span of 2 weeks or so. So DeepSeek showed us that a lot could be achieved with a lot lesser, and if we continually see innovation like this coming up, it could expedite the rate at which your AI is being commoditized, which will be a bad sign for Nvidia as well as its margins, so that could lead to a deterioration in terms of its ROIC over the next few years. Last portion, I'll be covering some questions left in the comments. So the first one, it says, your strongest stocks in my opinion are ASML, Google, Meta, as well as Microsoft. I think long-term Nvidia and Tesla won't disappoint despite current situation. Do you allocate a small part of your portfolio to smaller cap stocks or short-term opportunities? So I do own some small caps, I'll be sharing about them soon, but some of them involve coal plays. So your coal prices are extremely depressed right now, and there could be an opportunity there. But in general, I don't really like owning small cap companies unless it's a deep value play at a company that I own today. Small cap plays tend to be a lot more speculative and a lot less predictable. And what I want to achieve with my portfolio is to own a basket of high quality predictable businesses that won't run out of business anytime soon. So I tend to shy away from small cap companies unless they're really deep value, like the company that I own in your coal industry. The next question, it says, can you look at Booking Holdings? Beware of their buyback program, dividend, and cost reduction program. So for Booking Holdings, I think the company's fundamentals are great. The company has recovered from its COVID low back in 2020, 2021 or so, and the company is growing healthily in almost all fronts. But for Booking Holdings, this is my problem with the business. Firstly, the company is extremely reliant on Google Ads in order to drive traffic to its own website. And secondly, the entire user interface in your Booking.com website is inferior to your Airbnb website. But for Booking, the current competitive advantage is their ability to drive down prices, which is not a sustainable mode in the long run. So of course, there's an argument to be made that the company has network effects. So for Booking Holding, it is a company with an incredible management team with sound capital allocation. The company has been buying back shares, the company has reduced its stock-based comp significantly, and a lot of your compensation for the management is tied to the success of the company. But for Booking, the largest market right now is currently in Europe, and Europe is projected to have around a 3% growth over the next 10 years, and there could be some sort of normalization in terms of the growth. So coming out of COVID, we saw a lot of traveling. We saw an incredible growth story for Booking ever since 2020. But with your travel market projected to slow down over the next 10 years, this could hurt Booking's growth, and currently at around a 37 times earnings, I think Booking is on the expensive side. Hope you guys have found this one useful and invest safe.